Divorce is one of the most financially complex events a person can face. The decisions made during this process can shape the next chapter of a life for decades. Welcome to Advisor in Your Corner, the podcast for individuals navigating the financial realities of divorce in California, and for the attorneys, mediators, therapists, and coaches who support them. Your host is Alex Weinberger, a certified financial planner professional and certified divorce financial analyst. Through his firm, Marriage Financial Solutions, Alex consults directly with clients on the financial side of divorce, and the firm welcomes engagements from listeners and from the professionals who serve them, bringing clarity to the questions that matter the most to you without the jargon. This is Advisor in Your Corner.
Here is a number worth sitting with. In a lot of the California divorces I see, the single largest asset on the table is not the house, and it is not the retirement account. It is a block of restricted stock and options that has not fully vested yet. And the way that block gets divided can swing by several $100,000, depending on two things: one date and one word. The date is the date of separation. The word is the difference between a grant made to reward work your client already did and a grant made to keep your client around for work they have not done yet. If you have handled an executive or a tech founder through a divorce, you already know this is where the real money moves. It rarely feels that way at the first meeting because the equity is abstract. It is a line on a portal, not cash in an account. But by the time you get to the property division, it is often the biggest, least understood number in the case. So what I want to do today is walk through how that money actually moves and where a financial partner earns a seat at your table. Here is where we are going. I will start with why unvested equity is community property at all, even when it vests years after the marriage is over. Then the two formulas California courts reach for, and why the choice between them is really an argument about what a grant was for. Then the date that quietly decides everything. Then the part that destroys more settlements than any other, which is tax. And finally, the mechanics of actually dividing this, because it does not work the way a retirement account does. Stay with me to the end, because that last point is the one I see good lawyers miss most. Let me start with the threshold question, because clients fight about it. Why is a grant that vests 2 or 3 years after separation community property at all? You know the answer better than I do, but here's how I frame it for the client. California has treated contingent, not yet vested compensation as a divisible property interest for a long time. The Supreme Court said as far back as the Brown decision in 1976 that a non-vested right is not a mere expectancy. It is a form of property, a chose in action, and it can be divided even though it has not vested and might never pay out. Stock options and restricted stock followed that logic. So when a grant is made during the marriage, the community has an interest in the portion that was earned during the marriage, even if the shares vest long after the parties separate. The employee spouse almost never sees it that way at first. The instinct is, this grant is in my name, it vests after we split, I earned it, it is mine. And the honest answer is, some of it probably is separate property, but not all of it. And the line between the two is not a feeling. It is a calculation. That is the whole ballgame. So let us talk about the calculation. California courts use what is generally called a time rule. The idea is simple, even when the math gets fussy. You take a fraction that represents how much of the vesting period overlapped with the marriage, and you multiply it by the shares in that grant. That fraction is the community share. The rest is separate property. There are two classic versions of that fraction, and they come from two cases you will recognize. The first is the Hug decision from 1984. Under the Hug approach, the numerator runs from the start of employment to the date of separation, and the denominator runs from the start of employment to the date the shares become exercisable. Because the clock starts all the way back at the higher date, the Hug fraction tends to produce a larger community share. Courts reach for it when the grant is best understood as a reward for getting the person in the door and for service already given. A signing grant, or a grant that recognizes skills the employee already brought with them, fits that picture. The second is the Nelson decision from 1986. Under Nelson, the numerator runs from the date of the grant to the date of separation, and the denominator runs from the date of the grant to the date the shares vest. The clock starts later at the grant rather than at the hire, so the community share tends to come out smaller. Courts reach for Nelson when the grant is forward-looking, when it is really there to retain the employee and to incentivize work that has not happened yet. Let me make that concrete with a purely illustrative example, with round numbers chosen only to show the mechanics. Imagine an engineer. I will call her Dana. She is hired in January of one year, and 2 years later she gets a block of restricted stock units that are set to vest 4 years after the grant. Say the marriage breaks down 1 year after that grant. Under the HUG approach, the clock starts at her hire date. So the community period is the roughly 3 years from hire to separation, measured against the roughly 6 years from hire to vesting. Under the Nelson approach, the clock starts at the grant. So the community period is the 1 year from grant to separation, measured against the 4 years from grant to vesting. Same grant, same dates, and the community share comes out materially larger under HUG than under Nelson. I want to be clear that these are illustrative numbers to show the shape of the thing, not a result anyone should rely on. But you can see why each side has a powerful incentive to characterize the grant in the direction that helps their client, and why the documents that reveal what the grant was actually for are worth chasing down in discovery. Now here's the part that matters for you. The choice between HUG and Nelson is not a math question. It is a characterization argument. The real question is, what was this particular grant for? And the HUG court was explicit that there is no single formula that fits every case, that trial courts have broad discretion to choose the method that fits the facts, which means the documents do the work. The grant agreement, the board resolutions, the performance reviews, the language of the plan, the company's actual practice in handing out refreshers. All of it bears on whether a grant was looking backward or forward. This is exactly where I find attorneys get the most out of a financial partner. You are going to make the characterization argument. That is lawyering, and it is yours. What a CDFA partner does is turn each characterization into a number. Tranche by tranche, grant by grant. Here is what this block is worth to the community under HUG. Here is what it is worth under Nelson. Here is the spread between them. So when you walk into the negotiation, you are not arguing about an adjective. You are negotiating from a model, and you can see what the argument is actually worth before you decide how hard to fight it. Which brings me to the date. I said at the top that one date decides a lot, and it is the date of separation. Look at both formulas again, and you will see it sitting in the numerator of each one. The date of separation is the cutoff. Move it by a few months, and you move the community fraction on every unvested tranche in the case. In an equity-heavy marriage, that is not a rounding error. You live in this statute, so I will be brief. The current test asks for a complete and final break in the marriage, shown by two things together. One spouse has to have expressed to the other the intent to end the marriage, and that spouse's conduct has to be consistent with that intent. And the court considers all relevant evidence in pinning down the date. As you know, that can be genuinely contested, especially for couples who kept sharing a house or a calendar for a while. Here's the financial point I would make. In most cases, the date of separation is argued mainly as a support and acquisition question. In an equity-heavy case, it is also a valuation lever on the single biggest asset in the marriage. That deserves to be treated as a financial issue early, not just a procedural one, because the same testimony that moves the date a quarter in either direction is also quietly moving the value of every unvested grant. Now, the part that destroys settlements, tax. If you take one thing from this episode, take this one. The most expensive mistake I see in equity division is treating a share like a dollar. It is not. Different instruments are taxed in completely different ways, and your client's tax counsel will run the real numbers. So I will keep this at the level of why it matters rather than how it computes. Restricted stock units are generally taxed as ordinary income when they vest, on the full value at vesting. Non-qualified options generate ordinary income on the spread when they are exercised. Incentive stock options, the ISO, are their own creature, and exercising them can pull a client into AMT in the year of exercise. 3 instruments, 3 tax stories, and a settlement that ignores the difference is dividing pre-tax numbers as if they were spendable cash. Picture 2 grants that look identical on the portal, same face value. One is a block of restricted stock units that vests next year. The other is a slug of vested shares your client could sell tomorrow. They are not equal. One has a full layer of ordinary income tax still sitting in front of it, and the other does not. If you split them down the middle by face value, one spouse quietly walks away with more after-tax money than the other, and nobody in the room intended that. Courts have understood this for decades. In that same Nelson case from the 1980s, the trial court reduced the community portion of the options to account for the tax that would hit when they were exercised. The principle is the one I come back to constantly. You value equity after the embedded tax, not before. One more tax point, because it catches people. Transfers of property between spouses as part of a divorce generally do not trigger tax at the moment of transfer. That sounds like good news, and it is. But it does not mean the tax disappeared. It means the tax travels with the asset to whoever ends up holding and exercising the shares. Somebody is going to pay it down the road. So the settlement should decide, in advance and in writing, who that is. I am not giving tax advice here, and the actual calculation belongs to the client's tax counsel. What the financial model does is make the after-tax picture visible to everyone before anyone signs. That leaves the mechanics, and this is the point I most often see slip past even careful lawyers. Dividing equity is not like dividing a retirement account. There are really 2 ways to split it. The first is an immediate offset, a buyout. You assign a present value to the equity today, and you trade it against other assets. So the employee spouse keeps the shares and the other spouse takes more of the house equity or more cash. For options, that present value often gets modeled with a method like Black-Scholes, which tries to put a number on something that has not paid out yet. The appeal of the offset is a clean break. The cost is that it front loads all the risk onto whoever takes the equity side of the trade, because the shares might double or might go to 0 after the ink dries, and the trade is already done. The second way is deferred distribution, sometimes called if, as, and when. The non-employee spouse gets their fraction of each tranche if, as, and when it actually vests. That tracks reality much more closely. Nobody is guessing at a value. The cost is that it keeps 2 people who just divorced financially tied together for years. And here is the mechanical trap underneath both options. Most equity plans do not allow the employer to split a grant and reissue shares directly to a non-employee spouse the way a court order splits a retirement plan. There is no equity version of the quadro for most of these plans. The shares stay in the employee spouse's name, which means in a deferred arrangement, the employee spouse is effectively holding the other spouse's portion as a kind of trustee. They have to exercise or sell at the right time, account for it, and pay the other spouse over. That is an ongoing fiduciary-style obligation between 2 former spouses, and it has to be drafted with real care, because the non-employee spouse is depending on the other side to act, report, and pay year after year, often with no easy way to see the account. Pre-IPO equity raises the temperature on all of this. There may be no market to sell into, so the value is genuinely uncertain. The vesting may be tied to a liquidity event that has not happened, and that event could land the year after the divorce is final, which is a difficult thing to value today, and an even more difficult thing to ignore. In those cases, I find the energy is much better spent building clear mechanics for what happens at exercise or at a sale than fighting over a speculative number that nobody can actually defend right now. In a deferred arrangement, I think the financial side is most useful in the years after the decree, not just during the case. Someone has to keep the schedule of which tranches vest and when, calculate the other spouse's share net of the tax withheld at vesting, and confirm that the right amount actually changed hands. Without that, the order is only as good as one party's diligence and goodwill. And goodwill tends to be in short supply right after a divorce. A neutral set of eyes on the vesting calendar protects both people, the one who owes and the one who is owed, and it keeps a clean record if the question ever comes back in front of a judge. So let me bring this back to where we started. The block of unvested equity is usually the biggest and the least understood asset in a high net worth divorce. The number is not fixed. It is the output of a characterization argument, a contested date, and a tax assumption. Change any one of those and you change the result, sometimes by a life-altering amount. Where I see attorneys benefit most from a financial partner is right here. Not to tell you the law, you know the law. It is to turn the law into a model. To show you, tranche by tranche, what Hugg versus Nelson is worth, what the date of separation does to that number, and what is actually left after tax. So that when you sit down to negotiate, you are holding a spreadsheet instead of a hunch. The equity is never as simple as the share count makes it look. The whole job is seeing what is really there before your client signs something that says it is equal when it is not.
Thank you for listening to Advisor in Your Corner. If today's conversation raised questions about your own situation or a client's, Alex Weinberger and the team at Marriage Financial Solutions are available to help. They work directly with individuals navigating divorce and alongside the attorneys, mediators, therapists, and coaches who support them. Every engagement is handled with the discretion, rigor, and independence the moment calls for. To learn more or get in touch, visit marriagefinancial.com. If this podcast has been useful to you, please share it with someone who could benefit and subscribe wherever you listen. This has been Advisor in Your Corner. We'll see you next episode.
The information and opinions presented in this podcast, including the views of guests not affiliated with Marriage Financial Solutions, is for general informational and educational purposes only and should not be considered personalized financial, tax, or legal advice. Marriage Financial Solutions does not provide advice regarding securities or the advisability of investing in securities. Marriage Financial Solutions is affiliated with Weinberger Asset Management, an SEC-registered investment advisor, and may refer listeners to Weinberger Asset Management when investment advisory services are appropriate. However, individuals are not obligated to use the services of Weinberger Asset Management